as well. One thing we looked at here, the difference between a 2% and a 9%. The 2% is something that you might get with a certificate of deposit, a very risk-free investment. Risk-free over the next year because you know exactly what you're going to get over the next year. Whereas this 9%, this might come from investing in a diversified portfolio of stocks, for example. You don't know that you'll necessarily get 9% next year in that portfolio. In fact, you might actually lose money the next year. The thing is that over the long run, if you invest in the right portfolio of securities, you can earn 9% on average over 30 years. So in the long run, your biggest risk is that you don't actually take enough risk, if that makes sense. That is to say, there's the question of what risk is my money at over the next year versus what am I risking by not investing and earning the highest return over the long run. So when it comes to a 30-year investment horizon, long-term type of investment horizon, you want to take substantial risk. You want to invest in equities or real estate. That's different than over the short run where maybe you need some money for a down payment on a house or for your college tuition. You certainly don't want to take substantial risk with that money. So, how do we get started in investing? The first thing is to make sure that you're prepared for saving money, setting money aside. You should ask yourself, are you paying your bills on time? Are you able to pay your credit card payments off in full each month? That is, not carrying a balance. And in general, is your budget balanced? And over and above all this, do you have enough cash in case some sort of emergency happens, where you need an emergency car repair or you need to visit a hospital? Once you've got all these bases covered, we can start to begin looking at investing. And investing is a trade-off. The extra money that we set aside today to make investments, that's not going to be used now to do things that are potentially more fun. But remember, it doesn't have to be a huge amount of money to earn a return on investing over the long run. We can start small, even at just $1,000. Every $1,000 saved, if you can invest for the long run, turns into $13,267 after 30 years. So set aside $1,000 each month. You can turn that into $13,000 by the time you need to retire. Or even just set aside $100, and the difference is still the difference between money spent or set aside today versus that money received in the future. That difference is still quite large. The first thing you should decide when you're thinking about investing is what your time horizon is and what your goals are. If you have a goal of buying a home in the near future or a car, that's going to necessitate a different timeline than if you wanted to build a retirement nest egg. Or if you wanted to pay for children's education 5, 10, 15, 20 years down the road. The closer you need the money, the less risk you'll want to take on that investment. But the further out you can wait before you'll need that money again, the more risk you can take and should take. How do you get this mythical money to invest? Well, you could save the extent that you have ability. It doesn't have to be a large amount. You could, for example, take your tax refund that you get each year and then set that aside to savings. Or you sort of treat it as a bill you have to pay each month, like a $50 bill that's not really a bill, but it goes instead as a check to your retirement fund. These are two ways that are relatively simple to get started. Another way is to just take on a second job. When I was a student, I had a cool study job, is what I'd call it, working a night shift in a library on a second job, where I'd monitor the safety of the library, but basically I could read books during the night and get paid to do it. But regardless of how you get the money to invest, investing is not just about saving. It's not about just allocating the money. Investing is about what you do with the money as well. You can put it in a savings account, which offers a low yield but a certain return. But you can also invest in things like other securities like stocks, bonds, global mutual funds. There are a lot of different choices. And the choice depends on the amount of risk that you're going to take, because the return that you can get on an investment depends on its level of risk. If there's a lot of uncertainty about gains or losses, people are not willing to kind of buy that financial asset. And the only people that are willing to buy that financial asset are those that can kind of stomach the risk. And they expect that, if I'm going to buy this thing, I've got to earn a good yield from it. I've got to earn a good return. That's what these potential buyers of these high-risk products are thinking of. And that's the only way they're going to buy it. And so in the market, what happens is that generally those assets that have the highest financial risk offer the greatest long-run return. Return you can think of as just being the price growth of your investment. Your investment grew from $100 initially paid in to $1,237 at 30 years later in our previous example. That's like a return because the price went from 100 to 1,237. But your return can also come from the form of interest payments, rent, or dividends. In a savings account, for example, you get interest payments. And when you buy a bond, which is sort of like a IOU by a company, you also get interest payments. If you buy real estate, you rent the house out or rent the commercial property out, and you earn rent, which functions just like an interest payment. And similarly, you get dividends when you buy stocks in a company. That is, not only does the stock price go up, but you also receive quarterly, annual, or sometimes monthly income from the company that they pay out to your bank account in the form of something called a dividend. That's the nice thing about stocks, because you can have dividends that come to you each year, but you can also have that growth in price. That growth in price is what's called a capital gain. I bought it for 100, sold it for 1,237, I earned a capital gain. Or if I sold it for a price less than what I paid for, I experienced a capital loss. These things only occur once you finally sell the investment. And your total return on an investment is equal to that gain in price plus any current income, like dividends, rent, or savings interest. And the rate of return is just the percentage of the growth of these two things. For example, I buy a house and I earned 2% in the house's value in the form of rent. And then I sold the house later and I sold it for a 10% price increase relative to what I paid. Then the total return is here just 12%. If we look at total returns across a number of different assets, this study shows a few decades of return history for these different investment options that we can choose. On the safest end, we have Treasury bills. These are IOUs issued by the US government that mature or that last for 30 days. It's an IOU that you can buy from the US government and they promise to pay you back within 30 days. It's pretty low risk. But as a result, it only yields 3.4% as a total return per year. And remember, that stacks up over the long run, earning 3.4% versus some of these higher returns that we see up here. That'll make a big difference over the long run if you invest in this one versus the other. But if you need that 3.4%, that is, if you need that money back in the next year or so, at least you know you're going to get that 3.4% and your money back. There's no uncertainty involved with that. And you step up to bonds from other governments, to a more riskier option, bonds or IOUs from corporations who are perhaps less likely to pay you back than the government. And then beyond that, you go into the territory of stocks, which are even more risky still, because prices on these stocks, they go up, they go down, they go up, they go down. They're very volatile relative to things like bonds and treasury bills. But as a result of kind of that roller coaster ride over time, the difference is that stock performance over time tends to be on average much higher each year. And investing in the most risky types of stocks, that of small companies versus more large and stable companies with established business models, those types of risky investments earn the highest return overall. Let's go back to our example here, where we just look at the difference between investing in the biggest companies, the more secure ones, versus companies that are small and their business models are maybe less proven. Approximately 9.1% versus 11.4%. With the investing in large companies, we still earn a huge investment return relative to, say, government bonds or treasury bills, or just keeping it in a savings account. But when we invest it instead in small cap stocks, which are more risky, the difference in return is almost twice as much in terms of the amount of money that we end up with at the end of 30 years. So even small differences in risk taken, small differences in reward gained, can compound to big differences over the long run. So the takeaway here, the life takeaway here again, is accept substantial risk. Things like a diversified portfolio of small cap stocks when investing for the long run.